how do tariffs work? Who actually pays the tariff?
At the border, the U.S. company is going to pay a tariff to the U.S. Customs and Border Protection Agency. Then that tariff revenue is going to get remitted to the Treasury. Very clearly, U.S. companies pay tariffs. It is a tax on U.S. companies that import goods from other countries.
So more tariffs ultimately means higher prices for consumers, more inflation. That means Fed far less likely to cut, right?
Not necessarily. So during the first Trump administration and the first trade war, the Feds set the precedent of saying they were more likely to look through the increase in prices caused by tariffs and instead focus on the weakness in economic growth and potentially the labor market. If they take a somewhat similar approach this time around, we think that means 2 to 3 rate cuts in 2025.
Hello and welcome to the Deep Dive by CAP STRAT. Today we are going into everybody's favorite macroeconomics class subject, tariffs. Start with the basics, how do they work, and get all the way into market impacts, including Fed reaction function. So let's start there. How do tariffs work? There's some pretty common and widespread misconceptions around how tariffs actually impact the domestic economy.
So we'll run through this real quick. Canadian exporter ships goods to a U.S. importer. At the border, the U.S. Customs and Border Protection Agency collects a tariff from the U.S. importer.
Right.
All right? That's key misconception. This is not a tax on the Canadian exporter. It's not a tax on Canada. It is a tax that is paid by the importing company.
No external revenues collected here.
Exactly. The idea of creating an external revenue service to collect tariff revenue is nonsense. It's trying to sort of change the narrative and window dress what's happening here. This is a tax on U.S. businesses that bring in goods from outside the U.S.
Yeah.
That tariff revenue is collected by U.S. Customs and Border Protection, and then it is remitted to the U.S. Treasury. It looks just like any other form of tax revenue.
So when we think about it from the perspective of the U.S. importer, who is the one paying the tax, they have a couple of reaction options when it comes to that tariff.
Yeah, how they react to the tariff, how consumers react to them, and then how other nations and currency markets react to all of that. That all shapes the economic impact of tariffs. That's why they're so complicated and difficult to understand. So we're going to simplify it. We're going to start with a very simple scenario that is not going to happen, okay? It's the U.S. company just eats the cost. Dips right into their profit margins. What happens then? Lower corporate profits, smaller fiscal deficit. Simple, not going to happen. My dad taught me a long time ago, U.S. companies do not pay taxes. Consumers pay taxes. So what's more likely to happen is the U.S. company passes the cost on to the consumer. They raise prices. Now, how the consumer reacts to that depends on the type of good we're talking about. If the demand for the good that just went up in price is inelastic, meaning it's an essential, even if the price of this went up, I have to buy just as much. What's going to happen then? You're not going to see lower corporate profits, right? Because the company raised their prices. Yes, you'll see a smaller fiscal deficit. You'll see higher consumer prices. And the other thing you'll see is because the U.S. consumer has to pay more for this essential good, they have less money to buy other things. And so it crowds out consumption. You'll see slower economic growth.
Yep.
And then the last, more complicated, more likely scenario, the U.S. U.S. company still passes the cost on to consumers, but the demand for these goods is somewhat elastic, meaning if the price goes up, I'm going to buy less or I'm going to look to buy elsewhere.
Right.
This is where it gets messier. Now you do see lower corporate profits, right? Less demand for the good. Smaller fiscal deficit, a bit of a question mark. There are offsets here. Yes, they're collecting the tariff revenue still, obviously, but if corporations have lower profits, maybe that for other reasons, maybe that offsets it. Still see higher consumer prices, still see slower economic growth for the reasons we said previously. And then you start to introduce these two other factors, which are sort of the purpose of all this pain. The longer term effects, you have a migration of consumption habits. Now, hey, if this same good, but produced in the US, is cheaper, I'm going to shift my consumption habits towards that good. buy local, buy domestic. That's the aim of tariffs, a longer term effect here. And then finally, you're going to see reshuffling of supply chains. Those lower corporate profits are going to incentivize companies to either reshore or at least friendshore labor and production of whatever they're producing to try to avoid the tariffs. And that's a good thing long term, or at least that's the aim of the policy in the mind of the Trump administration. So that's sort of the purpose of the pain. And that's why tariffs get complicated. And we've really tried to simplify it here. There are a number of other complicating factors that happen. Another thing is currency.
Right.
Let's say usually what happens and what has happened is when tariffs go into effect, the US dollar gets stronger and foreign currencies get weaker. What impact does that have? Well, it makes goods that we're bringing into the US cheaper in dollar terms.
Right.
I could buy more with my dollar. So that could offset the tariff. So you could sort of be running in place here. The other thing that it does is it makes our exports less attractive to other countries, which we do not want. So there are some impacts there. Another thing, you could say, well, this is just one element of the Trump 2.0 policy agenda.
Get the tax cuts.
Exactly. Let's offset some of these negative impacts by tax cuts.
Yep.
If you're going to do that, yes, that should help. You're taxing U.S. businesses, so let's give them a tax break. U.S. consumers need to pay higher prices, so let's give them a tax break. The problem is you disincentivize these two things that you want, right? If a U.S. company can say, all right, I'm going to pass this tariff on to consumers and then I'm going to get a tax break, why would I need to reshuffle my supply chain? So you don't get the pain, but you also don't get the purpose. So that's one thing to think about. And then, of course, you have retaliatory tariffs.
Right. The other side of the equation.
Exactly. They don't happen in isolation. All of the tariffs that have been announced have, it's expected that they are going to be retaliated in some way, shape, or form. That obviously hurts our exports, and it just escalates, and a lot of these negative impacts go higher, and they become unavoidable.
Yeah.
Right?
Yeah. And the ultimate goal and the way that those tariffs are deployed have an important impact on our projections for economic activity and how the Fed's going to respond, right? So tariffs, at least from the U.S. perspective, has spent a lot of time in the news here to start the year since the Trump presidency has kicked off. But the market's expectations for how those tariffs are going to play out has changed pretty notably, and they seem to kind of filter themselves into a couple of buckets.
Yes. Yeah, generally 3 buckets. One is why you would implement tariffs. It's a means to secure cooperation or concession on other strategic issues.
Yep.
Sort of the art of the deal. Just a threat. Hopefully we don't have to follow through. Those are the ones in red.
Exactly.
I think Colombia in January 26th, that's the extreme version of this.
Yep.
We're going to put 25% tariff on all goods, 50% after a week if you don't solve this migration emergency that's happened here, if you don't accept these deportees. And of course, that was
already the deal to a T right there.
We also think the tariffs that have been threatened on Canada and Mexico are more in that bucket, more the art of the deal. And why do we think that way? Well, a number of U.S. companies have already gone through the pain of reshuffling their supply chains after the original round of tariffs and the Canada and Mexico agreement.
Right.
So it seems a bit nonsensical to then slap this tax on them, even though they followed what the original administration wanted. So we think this is more to get concessions on issues like the border and drugs and things like that. And we'll have this series of ongoing threats and negotiations until the formal review of the Mexico-Canada agreement, which is scheduled for mid-2026. All right, so that's one reason why you would threaten tariffs. And he's using it that way, for sure.
Yeah.
The next bucket you have are to protect some type of a domestic industry that we've decided is important for national security or prosperity, strategic importance. That's where you would see the tariffs on steel and aluminum that are set to take effect on March 12th, or the tariffs on autos, chips, and pharma, which are set to take effect on April 2nd. The last bucket, and then we'll talk about these tariffs on China. They're somewhere in between these first 2 buckets.
Kind of a combination.
There's an element of the art of the deal here. These things are going to ratchet up unless concessions are made. But then there's also, very
Protecting industries.
protecting goods and data and things like that. And then the last piece, tariffs can actually be a means to reduce tariffs that other countries are levying on our exports, and also reduce non-tariff trade barriers. And that is where you see the reciprocal tariffs.
Right.
So that review is going through to April 1st. We are, I wouldn't say excited, but it is exciting that reciprocal tariffs seem to have replaced the idea of universal tariffs.
Right.
Within the Trump administration, because reciprocal tariffs, they create a mechanism to de-escalate this whole thing. There can be a bit of the art of the deal and negotiation before these tariffs go into place. And maybe some of these other countries reduce the tariffs or non-tariff trade barriers they put on U.S. goods before the reciprocal tariffs are announced. And then our tariffs would be lower than they otherwise would have to be, our reciprocal tariffs, and their tariffs would be lower.
Exactly.
And it creates a path for de-escalation and a movement towards free trade.
Yeah.
That may be, claiming a lot right now. We haven't even seen the plans, but you can see there are a lot of different angles here with how these tariffs are taking shape.
Exactly. So it's our job to take these different angles and try to project how they could play out, and ultimately, from a tariff perspective, what their impact could be on inflation.
Yep.
Right? So as we talked about at the onset in terms of how tariffs work, very likely, almost certainly, we're going to see higher consumer prices if and when more tariffs are implemented. So what does that impact look like exactly for the next 12 months and then beyond?
Yeah, if we take all those tariffs that are priced in, we expect something like a 4 to 5% increase in the effective tariff rate. So 4 to 5 percentage points higher than the current effective tariff rate. And that roughly equates, if you assume all these companies are going to try to pass on, some successfully, some not successfully, pass on these tariffs to consumers, that you would expect about a 0.4% one-time increase in core consumer prices.
Right.
So if you look at core PCE or core CPI, those inflation indices, you would start to see some pretty big month-over-month increases, some shocks as these tariffs go into effect and they get baked into the data. So you can see that gold line there, that's our forecast for core PCE year over year with tariffs. And effectively, once these tariffs hit, based on our expectations, and this isn't even assuming all of them take place, they're watered down, it basically eliminates the possibility that the Fed reaches their 2% inflation goal this year.
Yeah.
And we've been saying that, since the fall, right? Without tariffs, you see we actually resume progress towards the Fed's 2% goal and continue to gradually move down to something like 2.3% as we get 18 months out.
Yep.
All right, sometime mid next year. So very different paths. The question, if you're the Fed, do you dare call this gold line or the inflationary impact of tariffs transitory?
It's a dangerous word these days.
Dangerous word, right? If you do, you look at it and you say, well, inflation 18 months out is the exact same.
Yeah, you're in the same spot.
Yeah, it's a one-time price shock.
Yeah.
So, there is precedent for them looking at it that way, and that has implications for our expectations for Fed rate cuts.
Yeah, absolutely. That begs the question, what is the Fed's reaction function? How are they going to view this? If they just took the tariffs at face value, higher prices, higher inflation, less willing to cut.
Yep.
Less looking forward to cut. But there is a precedent during a Trump presidency talking about tariffs for the Fed to look through the potential impacts of those tariffs.
If we think, because of the jump in inflation, it's transitory, we assume that policymakers decide to see through the increases in inflation and focus on the weakness in economic activity. Right? So see through the inflation for the sake of the economy and, of course, the labor market. If they follow that playbook, our models suggest 2 to 3 rate cuts are appropriate.
Right.
A full see-through of the inflationary impact. This is a much different starting point than 2019, however.
Right.
Inflation has been running above their target for 4 years now. It's going to be much harder for them to just say, we're going to look through this.
Yeah.
So, but we do think that is still sort of the reaction function. That's what they're going to try to do. And if they get a good excuse to look through it, like weakness in the economy and labor market, then okay, 2 to 3 rate cuts seems reasonable. Our base case is still 2 cuts.
Right. Yeah.
What would be worrisome is the opposite. Why would they not look through it?
Yeah.
And so that speaks to them speaking out of the other side of their mouth. This is all coming from the Teal book back in 2018 and 2019, right? If they're going to look through that inflationary impact, it depends on firmly anchored inflation expectations. So long-term consumer expectations of inflation, 5 years out.
Yeah.
If those start to rise during this transitory period, that is a problem. If that were to happen, no to 1 rate cut.
Yeah, you're way less inclined to cut rates.
Exactly, maybe 1 rate cut.
Yeah.
So the market is sort of trying to balance these 2 views and thinking about what the Fed's going to do. We've come out and said 2 cuts seems appropriate.
Yeah. Let's talk about inflation expectations, because they've been getting a lot of headlines. You know, the University of Michigan Consumer Sentiment Survey, highest long-term inflation expectation from consumers since '95.
Yeah.
Right, significant period. Breaking that down a little bit, adding a little bit of nuance to that, if you look at it by political party affiliation, right, it's split. Democrats expecting 5% inflation, take off, run away. Republicans expecting no inflation, right? So an interesting aspect of that report. And then from our perspective, more importantly, the bond market's inflation expectations. Those have historically been a better predictor of actual inflation, seem to be more stable, and we have not seen, certainly have not seen a run-up in longer-term inflation expectations in the bond market.
Yeah, the Fed's own measure of long-term inflation expectations from the bond market is a little over 2%.
Yeah.
So nothing alarming there at all. That's why we view this as being less likely.
Exactly.
Yeah.
So let's kind of set the stage here of, we're talking about these tariffs. There's a lot of different buckets and angles at play. What's the market thinking about tariffs right now? Are they overblown? Are they not priced in enough? What's the situation there?
Yes. Are they overblown? Somewhere in between. So the first place to look, the real-time gauge here, is currency markets.
Yep.
So if you look at a measure of the US dollar, how it's performed versus other developed foreign countries, that's your light blue line. The US dollar has strengthened a little over 6% since election time. And the question is, how much of that strength in the US dollar is explained by factors that aren't tariffs, right? Things like just economic fundamentals, differences in interest rates,
interest rate expectations. Yep.
That, it's hard to measure, but we measure it with this blue line here. And you can see there has been a good amount of dollar appreciation that's not explained by other fundamentals. So that gap, if you will, is the tariff risk that's priced into currency markets. Peak tariff risk was January 13th. Since then, the US dollar has weakened a bit.
Yep.
That gap has closed. And that's when you started to hear quotes come from Trump about how he would rather not impose tariffs on China, and that this isn't going to be a day one slapping a universal tariff on everyone. Yeah. So sort of de-escalating the situation prior to inauguration.
Yep.
So we would look at that and say, okay, the gap is smaller than it was, but there's still a gap. So there still is some tariff-related fear priced into currency markets. But not a lot.
Right.
And we still think if these tariffs go into effect, this gap would widen out even more going forward. So that's on the currency side. This is, I mean, it's hard enough to do it with currencies. It's even harder to do it with the equity market, which is what everybody's more concerned about probably. But if you look at since mid-October, when equity markets really started to bet on a Trump win.
Yep.
The S&P 500 since then is up a little over 3%. A basket of foreign developed stocks is up a little over 1%.
Right.
So a little bit of a gap there. Not a lot of, in our view, not a lot of tariff risk priced into equity markets at all.
Yeah.
Believe it or not. A lot of that seems to make sense given what's been going on with the Fed and inflation expectations and earnings and DeepSeek and things like that. If there was more tariff risk priced into equity markets, we would expect that gap to be bigger, the U.S. outperforming non-U.S. stocks by a larger margin, And we would probably expect both of those figures to be negative.
Yep.
So still more shoes to drop for equity investors. They are the ones out of all financial markets, if you think bond market, currency market, equity markets, the equity markets are the ones calling Trump's bluff on tariffs.
For sure.
Currency markets taking him somewhat seriously. Bond markets seem to be taking him pretty seriously.
Yeah.
If the tariff risk that's priced into equity markets goes from sort of underpriced calling Trump's bluff to overblown, that in our view would be an opportunity.
On the foreign equity side.
Yeah, exactly. Or if we saw economic fundamentals outside of the US start to get better, or these tariffs just don't materialize. Those are all reasons why foreign equities would start to look attractive, and they've already outperformed US equities year to date, and they are cheap in our framework, so that's something we're watching very closely.
Yeah, certainly a potential opportunity coming down the pipe here.
Yep.
Well, that will do it for this edition of the Deep Dive by CAP STRAT. If you have any questions or comments, please feel free to reach out.